we're going to retire this business owner client of ours on $1 million a year within the next 20 years. So here's the gist. This client of ours is in his mid-40s and he's essentially starting with no properties, a few $100,000 in cash, and a few $100,000 in his superannuation. So here's the plan. In 2024, there's 2 property purchases. One in the SMSF, one in his personal name. In 2025, there's another purchase in his personal name. In 2027, there's another purchase in his personal name. In 2029, there's another purchase in his personal name. And then we do not buy any properties for another 6 years until 2035, and then another one in 2038. Now, as you can see on the right-hand side here, the first 5 purchases are all residential assets. The last 2 purchases are commercial assets. What you'll notice is the rental yields on the residential purchases are much lower and the growth is much higher. Whereas on the commercial purchases, growth is lower, yields are higher. The difference between the rental yields as well is that in residential, it's a gross rental yield, and in commercial land, it is a net rental yield, meaning that the only cost you have to pay out of your rental income when you own a commercial asset is generally your cost of debt or interest payments. So let's go unpack it. So here's 2024. Purchase number 1 in the SMSF and purchase number 1 in the personal name. Both high growth residential assets that are both negatively geared, which is very common for residential assets. And just to be clear, we do not invest in residential real estate for cash flow, and I'll explain why later. So by 2030, we've essentially gone through and acquired all of the residential assets we're going to acquire. And what you'll see is that we are running at about $110,000 negative. That's based on a 6% interest rate, interest only. Essentially what we've done up until this point is reinvest all of the available equity in every property into the next property as soon as it becomes available. And when we look at where we are on our investment life cycle, this is where we are, the accumulation and the acceleration phase. Because at the start of your wealth creation journey, you should not be worried about cash flow because you cannot generate cash flow if you do not have any wealth. This is where so many property investors go wrong from my point of view. If you have a net worth of 500 grand, how the fuck do you expect to generate cash flow off that? Even at a 10% yield on your net worth, you're generating $50,000 per year. So don't focus on cash flow. Focus on growing your net worth, because the larger your net worth is, the more cash flow you'll generate. Back to the strategy. Now remember, from 2029 to 2035, we do not acquire any more assets. We just simply let the marketplace grow our properties for us and we just hold them. So as you can see, when we get to 2034, our negative cash flow is still sitting at $70,000 per year. And again, when we look at our investment strategy, this is the part of the strategy which is called the incubation phase, which as you can see, it says letting the marketplace do the heavy lifting. So this is when you've gone through, you've acquired assets, you're now sitting on a large gross asset value. And by simply doing nothing and letting the marketplace grow the property's values, your loan to value ratio will decrease just simply by the asset values increasing and you not having to pay off any of the debt. And then we move into this next phase, which is the consolidation phase, which is exactly what I'm going to run you through next. Which is when we start selling down our residential assets because they've done their job, they've grown in value, they've created some net equity for us, and then we want to reinvest that net equity, which is exactly what we do in 2035. We sell down the first residential asset that we ever purchased, which is the one that's being purchased in 2024, and we then reinvest that into a commercial asset at a $4 million value, which requires about $1.2 million worth of cash, which there's no way we would have that today if we didn't buy the residential asset and allow that to grow in the marketplace for 10 or 11 years. So you can see then our negative cash flow goes from being negative $70,000 a year now to being neutral. So we're still not producing income, but we're not negative now. And now that we're starting to consolidate our debt, sell down our residential assets and move that capital into something that's going to give us way more net cash flow, and we choose commercial assets, this is called the evolution phase, where essentially we're going through an evolution as an investor from growing our net worth into allowing that net worth to now produce us income, because growth is no longer important to us because we're at the back end of our journey and we now want to enjoy life, which we need cash flow for. So from 2035 to 2038, we start to sell down some more of our residential assets that we bought early in our journey, and we then roll them into another $4.5 million commercial asset. And what you can see now is we went from only a few years ago having negative $70,000 cash flow to now having $211,000 of positive net cash flow. And we still have 6 years until we need to retire. So we're not going to be living off that cash flow for the next 6 years. We're going to be using that cash flow to offset our debt, of which will then produce more cash flow because we'll have less debt. Which you can see here in 2038, we hit peak asset value of $11 million. We're sitting at about an 80% loan to value ratio because we've got $2.6 million of equity. And we've also got $1.1 million in cash, which is the cash that's come out of one of the sales. Now in 2039, the following year, again, we sold down another residential asset. Our equity position doesn't change, but we bank the remainder of that cash. And we're essentially now sitting on about $4.5 million worth of equity and cash together, which means we're sitting at about a 50% loan to value ratio. And now we have 5 years into retirement, which is 2044. And now when we get to retirement, the asset value is just under 11.4 million. We're sitting on $4.6 million worth of equity, and we're sitting on $3.85 million worth of cash, which is all of the cash flow that the properties have been producing. We've been putting in the offset account for the last 5 years. But we've now got an $8 million net worth, still carrying some debt, which is okay. And our net cash flow now in 2044 is $597,000, which is being generated of about $8 million of net worth, which works out to be about 7% net on our capital. And we also have $3 million sitting in our SMSF, which you can see on the bottom line there, which again, I would not leave in residential property. Because we are now into our 60s, we can sell that asset down, which is what we've done here. As we move into retirement phase, we pay no capital gain tax on that money either, because it's inside of superannuation. And then I would personally invest that cash into something else that's going to give us 6 to 7% net, which on $3 million of capital will give us about $180,000 to $220,000 of income a year, of which is net income as well, because it's inside of superannuation and we're now in pension phase. So combined income between the income our commercial assets are producing plus the income that is coming out of our superannuation, we're sitting on about $1 million a year now of income. That, my friends, is how you use property to grow your net worth and then use your net worth to go and produce income.